U.S. Federal Reserve has begun its two-day meeting amidst calls from Donald Trump to take the victory and not hike rates. Investors see a 74% chance of rate hike. Tanvir Gill joins us for more details. Tanvir, decode the Fed FOMC meet for us.
Well, a 71% chance that you'll have a rate hike in the December meet, the meet that extends out. And local time, Thursday morning, we will know what the decision is this time around. I think there are multiple pressures that the Fed is facing. One is whether the growth momentum, the sugar rush, that the big tax breaks introduced by President Trump last year, whether they can actually continue to fuel growth into 2019 as well. Because once those tax breaks, the buffer from there withers off, you will see, perhaps some scaling of growth downwards. So that's something that the Fed will comment on. They'll comment on how the US-China trade worries could be impacting the growth outlook for 2019. So really what they do in the current Fed meet would be important, because President Trump has been quite vocally putting pressure on the Fed to not hike rates. So that's why the expectation broadly is scaled down from 90% to 71% in terms of a broad expectation that they would move. But aside of that, I think the outlook on rates for the next year, based on what they believe growth would be like for 2019, would be just so critical in the commentary that the Fed puts out. And I think that's where all eyes would be centered. Aside of that, the usual outlook on employment and inflation would be key, but squarely the market will be watching out for what the Fed's assessment is on whether or not this 3.5% growth can sustain itself, and how intrinsically and inclusively growth is looking sustainable for 2019.
Thank you, Tanvir, for getting us what to expect from the FOMC meet outcome. Now let's listen in to Yan Den of Ashmore Investments on his expectations from the Fed meet outcome.
Chairman Powell came out, with all guns blazing back in the second quarter when we had 4.2% growth. I think that was a bit of a policy mistake, not a massive one, but it was a policy mistake, because essentially that strong growth number was precisely due to the sugar rush from the tax cut. And as we've seen, despite the enormity of this tax cut, it has not had a lasting effect on growth. And there are a number of indications across the board in very broad fashion that the U.S. economy is beginning to run out of steam after a very, very long rally. We see it with the growth numbers that are coming down. We're probably going to get a growth with about a 2 handle in this quarter, down from 4 in the second quarter. We are seeing it in housing, which is clearly weakening. And we are, most importantly perhaps for the markets, we're seeing it in company costs. Costs for American companies are now eating into earnings. And the costs are rising due to an overvalued dollar, due to rising interest rates from the Fed, due to rising wages, because we have full employment and it's no longer possible to outsource to other countries because of tariffs, and of course the direct effect of tariffs as well. And none of these effects are going to go away anytime soon.
Second tweet in a row from Donald Trump nudging the Fed ahead of its meet, ahead of the all-important outcome of the FOMC. He says, don't let the market become any more illiquid than it already is. Stop with the 50 Ps. Feel the market, don't just go by meaningless numbers. Good luck.